Welcome to PhillipCapital Expert Talk. My name is Sam from Unit Trust Research. Today we are honored to have Mr. Stephen Nicholls, who is a head of fixed income product specialist team in Aberdeen Asset Management. Based in London, Mr. Stephen has this team with responsibility for delivering fixed income investment content to a firm's fixed income clients. He joined Aberdeen in April 2011. Prior to joining Aberdeen, he worked at PIMCO for over 6 years, and before that spent 21 years at UBS Global Asset Management, where he was responsible for UK client relationships, for promoting the firm's fixed income investment capabilities, and for fixed income new business development. And today, he will be providing us some expert inside views on emerging market data. Thank you, Mr. Stephen, for taking out time for the interview. Let's get started with the questions. Almost all bond types claimed positive returns in third quarter as interest rates stabilized after the Fed shocked the investors with its no tapering decision. Now the recent FOMC minutes show that most of the members believe that Fed should start reducing the asset purchase program shortly. In any way, tapering will happen eventually. And once that happens, there's a chance that the interest rate sensitive part of the economy, such as the automobile sale, housing sales, etc., will be poised for a slowdown. Do you think that there will be any such significant ramifications in the market?
I think it's important that you're absolutely right that philosophically the Fed want to have an exit program from their quantitative easing strategies. What they need, though, is the economic data to justify that exit. And in fact, the most recent comments from FOMC members was that they feel, in some instances, that the preconditions have been met for them to withdraw quantitative easing, but they think patience will actually be rewarded. So to some extent, we have to differentiate that there are two reasons for removing quantitative easing. The first is the economic, and does the economy justify the withdrawal of quantitative easing? And the second is the more philosophical, which is actually that an exit program is one that is most desirable. But quantitative easing is there for a reason. It's there because the economy demands it. And the big question in all of this is the economy growing with sufficient vigour and sufficient strength that the quantitative easing program can be withdrawn? Now, within the Fed, opinions differ as to how that withdrawal should take place. In fact, some members of the Fed suggest they do nothing until early spring next year. Other people suggest that they might actually implement a tapering which begins in December, then is followed through to April or May of next year. There is no real consensus from the evidence that we can read as to exactly which policy they will take, but all of the comments that they make are that patience in this instance is going to be a virtue. Now, interestingly, if you look at the definition of a word surprise in the Oxford English Dictionary, it says a wholly unexpected event. Now, of course, the quantitative easing tapering is not wholly unexpected because it's being discussed ad nauseum now in almost every financial centre of the world by financial experts and so on. So to that extent, will it have the same impact this time as it had in May when Mr. Bernanke first floated the idea of quantitative tapering withdrawal? And the answer to that is almost certainly not, because already US Treasury yields have responded, so we have yields comfortably higher than they were before the tapering talk began. However, I think it is quite likely that on the announcement of tapering, it is quite possible that Treasury yields do tick up a little bit. But of course, quantitative easing at the root depends on strength in the US economy. And the jury is out as to whether the US economy has enough strength. One of the interesting things about the United States economy is that inflation is just simply too low. So to that extent, yes, there is a very strong likelihood of quantitative easing in some measure, and probably by spring, either through short withdrawals over a period of months, or in fact more dramatic, back-ended. But I think quantitative easing will happen at some point. The question, of course, is what happens then. We're now moving to a world of forward guidance. But having said that, we don't think that the bond markets will react quite as negatively as it did previously.
For past 3 decades, high-quality bonds consistently produce positive real returns. But now with nominal rates near historical lows and almost in line with the inflation rates, what do you think the scope of such bond remains, especially for investors who are looking for a decent real returns on their investments?
Of course. You're absolutely right. We have been living in a 3-decade-long bull market for bonds. But let's talk about the origins of the starting point of that very high nominal interest rates, particularly in the United States. This was during the Volcker era of chairmanship of the Fed. And he drove interest rates up in the United States because inflation had proven to be a problem. So inflation in the early to mid-teens. So to that extent, the policy response at that time was to drive both nominal and nominal bonds much higher. Since then, of course, we've seen inflation has actually declined pretty well throughout all that period. There have been reasons for that. Obviously, economies are better managed, they are less regulated, and to that extent, that has been a benefit. We've also had the globalization miracle, which is goods produced in Asia, goods produced elsewhere, have tended to reduce the price level in Western economies. So to that extent, it is indisputable that there has been a decline in yields. More recently, of course, the decline in yields are attributable to the quantitative easing, the fact that the Fed have expanded their balance sheet, the Bank of England, the Bank of Japan, and so on. So to that extent, the reason why developed economies are trading with wafer-thin real yields, as you rightly point out, is actually because the market level is being manipulated lower as a direct consequence of the policies. And this is a policy, that is to say, you punish savers by holding nominal interest rates actually either at or below prevailing interest rates. So what remains? Well, it's not true to say that there are no real returns within bond markets, and in fact, many bond markets do actually exhibit stronger real returns. Emerging market debt is a case in point. In Brazil, for example, nominal bond yields are at or close to 12%, which is comfortably much higher than inflation in Brazil and comfortably much higher than inflation in most other developed economies. So to that extent, what investors should be doing, and many are of course, is to look for value within bond markets such as countries such as Brazil, which we think actually offer attractive nominal yields, attractive real yields, and therefore are likely to receive portfolio inflows over time.
During last quarter, credit-sensitive debt such as corporate and emerging market debt led the market, hoisted by steady economic data and continued stimulus program. We all know that, right? A lot of analysts are favoring emerging market debt due to higher spreads and relatively low default rates on top of other fundamental reasons. Now, do you feel the same way about these markets now?
So in September, the Fed actually committed their second surprise. The first was, of course, in May when they floated the whole idea, and they led us through the whole of the summer believing that they would taper. And so the second surprise was, of course, in September. And since then, we have seen quite a significant move actually in markets, because what that meant was that whilst people had got into the mood and the idea that there would be tapering, of course the Fed said yes, but not yet. So it has meant that people have re-examined the economic case for tapering. And of course the most important thing about the economic case is that there has to be stronger growth such that the US economy in particular can grow with it under its own steam. At the moment it's growing because nominal interest rates are very low, and until very recently, of course, that meant mortgage rates were also very low. But the question, of course, is, does the economy have enough steam? Does it have enough power in order to continue to grow? So to that extent, the reason why bond markets have done well, particularly after the tapering, is it's been a reassessment about what the future holds. And perhaps now the future isn't as scary as it might have been in the early summer when the Fed first announced the idea of tapering. So to that extent, this reassessment has meant that people have looked at markets and said, actually, you know, some of these markets, these higher income markets, such as emerging market debt, and as your question absolutely correctly highlighted, these markets actually display much, much better fundamentals, lower debts, growing populations, and attractive nominal and real yields. So actually the reaction function by the investment community has been entirely sensible. They've reassessed the outlook for the future in terms of the quantitative easing, and they've looked at those markets which actually sold off quite significantly and actually regard these markets as being attractive for investment at this time.
Okay. Then which countries within emerging market are you heavily weighing on in terms of positive risk-adjusted returns?
So in this environment, the Fed have created an air of uncertainty. That is to say, we are constantly looking to see whether interest rates might go up as a consequence of a data release, or, I beg your pardon, when I say interest rates, I mean quantitative easing, or whether in fact it's going to remain on hold for a little bit longer. So to that extent, we have this air of uncertainty. Now, in this uncertain world, it tends to have been reflected most acutely in the local currency markets within emerging market debt, and in fact, they were the ones that were most badly hit earlier in the summer. So to that extent, what do we favour? Well, we think for the time being at least, it's very much a rate story in emerging market debt. We're favouring holdings of local debt, but hedged into the United States dollars. In particular, we think markets of Brazil, we think markets in Mexico, and in particular, we think Russia actually show particularly attractive risk-adjusted returns at this time, because it's a classic bond story. High nominal yields, high real yields, reasonably well-managed economies, no particular threat for an inflation pulse in any of those countries, and actually a good opportunity to invest in an attractive asset class with, in time, the prospect, once they've worked through their current tightening cycle, of potential declines in the future.
If you look at the past performance for bonds, you see year-to-date returns for most bond types posted negative returns, including the emerging market debt, which lost around 5.1% in terms of local currency so far for the year. Now, what is the future upside potential for such bonds? And is there any chance we could enter a bond bear market, let's say in 2014 or maybe 2015?
So you're absolutely right. All markets have performed poorly in this quantitative easing discussion. When Mr. Bernanke floated the idea of quantitative easing, it caused a reassessment more generally. I think it's important to reflect that in the case of emerging market debt, this isn't a crisis caused by any country or any region specifically within the emerging economies. Yes, some economies have higher current account deficits than others, and those economies are the ones that have been punished most in the market. But having a large current account deficit in itself isn't a reason why an economy can't grow. Current account deficits can be funded through foreign direct investment or through other portfolio inflows. But actually what we have seen is a sell-off in emerging debt that is consistent with sell-offs elsewhere. Sometimes I speak to existing investors and I ask them a question: are you at all concerned about the sell-off in emerging markets we've seen since the summer? And they look at me rather quizzically as if I've asked the strangest question. And they say, no, not at all. This is exactly what we expect in terms of the asset class. We're given a higher yield and there will be period bouts of volatility. So we would say that we're in one of those periods of volatility at the moment. Now, in terms of your last part of your question, are we at risk from being in a potential bear market in 2014 and the years subsequent to that? Well, bear markets in bonds are generally caused by a macroeconomic shock. If you look at the 70s and you look at the 80s, the macroeconomic shock was inflation breaking out on the upside. In fact, if you look at the environment now, the economic environment, in fact, we're faced with quite the opposite pressures, which is that inflation is actually almost too low at this stage of the economic cycle. There is a coherent argument for actually adding stimulus now based on the current inflation projections, particularly in Europe, which is extraordinarily weak, and also in the United States, where inflation is comfortably below the Fed's target. So to that extent, certainly in the horizon in 2014 and 2015, there doesn't seem to be the macroeconomic shock developing. So to that extent, we would say that a bear market for bonds beginning in 2014 is extremely unlikely based on observations about current economies. There's still a lot of spare capacity in the economies, so the inflationary pulse is unlikely to be resulting in that macroeconomic shock. And in fact, if you look at Japan, One of the things there is there has been higher inflation, particularly so since the summer, but there are very, very big question marks as to whether that can translate into wages. And these are referred to as the second round effects of inflation. That is to say, will it actually become ingrained through higher salaries, higher wages paid to workers? And in almost in every centre of the world at the moment, that isn't happening with any sense of vigour. So I think the answer to your question, put simply, is it's extremely unlikely based on current economic settings.
During the last quarter, foreign investors pulled funds out of long-duration government and corporate bonds in emerging market on concerns over Fed tapering and other fundamental issues. For instance, Indonesia, which is facing worsened trade imbalance and slow economic growth, saw its dollar bonds tumble around 20% based on HSBC's Asia Bond Index. Now, although this has been stabilized over the period, but how do you feel the spreads for such countries, especially Indonesia and India, heading towards?
Okay. So you're absolutely right. In fact, Indonesia in particular performed very poorly, with bond yields rising over 3% to 3.4%. Since the no tapering announcement in September, quite a lot of that high yield has been restored. So actually, if you look at the sell-off and then you see the recovery, which in Indonesia's case were both very dramatic, actually the total rise in yields that we've seen in Indonesia is entirely consistent with the rises of yields we've seen in many other Asian countries. Now, we do think that there are some interesting points to be made about certain countries. Actually, we don't favour the Asian countries in relation to countries in LATAM in particular, where we think there are better opportunities. It doesn't mean that from a credit perspective we have significant concerns about Asian countries by any means, but from a relative value judgment, it just simply means we see more opportunities in other countries, particularly at this moment in Brazil, Mexico, and also in the Eastern European emerging economies such as Russia.
So, do you have any recommendations on how to balance the fixed income portfolio in terms of different bond yields, duration, high, low quality bonds, public-private bonds, developed emerging market bonds for medium to, let's say, a long-term time horizon?
Okay. So I think there are two questions that face most investors, whether they're retail investors, institutional investors, here in Asia, in Europe, and in almost every other region. The first question is, where can I find income? And the second question is, how can I hold on to it? Right. So in this environment, of course, there, as your question highly regardedly highlights, is yes, there are a number of facets. Generally speaking, against this background of uncertainty, we would recommend having a slightly shorter duration relative to the perceived benchmark. We think that there are some income markets out there which are still extremely attractive. In particular, emerging market debt, from a valuation perspective, is particularly attractive. Corporate bonds actually are also particularly attractive, whether they're high yield in particular, or some investment grade companies. So to that extent, I think the most important thing is you have to stick to what you know, which is generally, if you make good selection decisions through fundamental research, which is a hallmark of Aberdeen's approach, actually you can select good countries and good companies based on sound fundamental research. So overall, we would say having a modestly shorter duration position at the moment is a good idea. Having an exposure to certain higher income regions, such as emerging market debt, is very good. And when you look at corporates, both in the emerging region and elsewhere, actually you have to be complimentary about how the balance sheets have been deleveraged over the last few years. So there have been significantly improving fundamentals. So overall, we think that the corporate sector is still an important source of returns going forward. But like all these things, you've got to do your research, you've got to make good selection decisions, and that is what will see people through over the course of the next 2 to 3 years.
Well, thank you, Mr. Stephen, for your time.
Thank you, it's my pleasure.
Well, that's all for today. For more information on unit trust investments, you can actually visit us at www.unittrust.com.sg.